Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, March 13, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And it was a pretty decent down day today. The Spider was down $1.91, 0.75% basically. The S&P 500 was down almost 18 points on the cash index. The Dow was down 171 points, and the Nasdaq composite was down 1% or about 77 points. So all in all, it was a decent down day. So let's recap of where we are from the discussion last night. We said the market really had three things it was going to do. It was either going to go sideways, building energy for another move higher. It was either going to pull back and be supported at, most likely, this downsloping trend line. So that seems to be the one that's in play right now. We don't have to hold this trend line, but at least from a short-term perspective, I would expect a bounce off that trend line. You also have the 50 moving average moving into that trend line, and you have the 20 moving average sloping up toward that trend line. So there's a little bit of a safety net there. Remember, the market really is back in a short-term uptrend in terms of being above the moving averages. We had a really nice rally off the secondary low that was made. We completed an ABC pattern, right? So we had the A, the B leg, the C leg officially completed from a technical perspective, so that's complete. And don't forget, we also had the red line. The 278.80 was a red line. Now, it's within pennies, whether it's above there by a few pennies or comes up a few pennies short. That's my mathematical number that I determined to be extremely important to the market. And it also coincided with the 278.92. That was the pivot high from the 27th of February. So that turned out to be very good resistance to the market. And then we had the down day today. Yesterday, we put in what I like to call the pseudo doji day. And that's generally a signal of a trend change. Now, we got the trend change today. Now, the question is, are we going to have more downside, or is this just really working off some of a short-term overbought condition, build some energy for another move higher? Remember, the line in the sand is really a close below the low from Friday. The low from Friday is 275.34. If we close on the daily chart, so if we close any day below that level, 275.34, that's going to be negative for the market. That'll put us back inside this channel here, or this triangulation that we had. We took off the bottom portion of the triangle. But if we go back in there, then that really takes this trend line off the table. There's a gap here, and the gap comes in at 274.10. So that's another safety net that's right around those moving averages. So there is definitely some support coming up if we go down any farther. Remember, this is options expiration week. The market can do strange things. Expect the unexpected during the week of options expiration. It's also quadruple witching options expiration, which means we have 4 asset classes expiring this week on Friday. So we have to be a little weary. A lot of times it has a bigger or larger impact, meaning options expiration has a larger impact on individual stocks, but it also can have an impact on the indexes themselves. So we'll see what the next couple of days has in store, but I will tell you that if we get back below this trend line and close below there, I'm going to take that as the first indication that the market is relatively bearish, to say the least. And if we get below there, expect the market to test around 270.5, right in this neighborhood right here. That's an area that if we do get below and close below this level right here from Friday's low, then I think the next major level of support on the downside It's nothing goes in a straight line. We'll get, little rallies along the way, but I think the market will want to come back and test that 270 and a half neighborhood on the downside. So keep that on the radar screen. Write that number down. If we should have further selling in this market, I think you ought to know about that 270 and a half area. One thing I will say is don't fall in love with the downside just yet. I don't see the market collapsing. I don't see the market just falling out of bed. I don't see there being right now a trap door that opens up. I'm going to attribute some of the downside activity today to the fact that the market was in a short-term overbought condition. And remember, and this is straight out of the Lazy E-mini Trader course, the market went up from the latest pivot low 7 days. 1, 2, 3, 4, 5, 6, 7. Put in a pseudo doji candle and had a reversal today. Now, there's more numbers found in the course, and I explain why these are important and how we use them each and every day to our advantage, whether it's on a short-term 10-minute intraday chart or whether it's on a longer-term chart, hourly, weekly, daily, monthly. It doesn't make any difference. Those numbers are important, and yesterday we discussed the fact that together, that time frame that the market moved higher and putting it together with the pseudo doji candle was important. So certainly nobody that's taken my course at Lazy E-mini Trader was surprised to see downside activity in the market today. At minimum, we were going to see some sideways, if not some downside activity today. That's normal, common market behavior. Looking at the hourly chart, again, right out of the course, here we go. The first hour of the day, the first hourly candle of the day. This is the candle ending at 10:30 a.m. Eastern Standard Time is a pseudo doji candle. And what happened? It's a signal of a trend change. We got one yesterday and we saw the same type of activity. We saw the next candle go down. Here's another one today. We had a gap higher. It's called a gap and crap. So we had a gap higher and we saw a pseudo doji candle. And what happened? The next candle was down. We went sideways for a few hours and then we finished kind of near the lows of the day. Not on the lows of the day. We had a little bounce at the end of the day. But this is textbook stuff video stuff right out of the course at Lazy E-mini Trader. This is just a snippet of the things that traders learn on how to read the markets. All charts act and react the same way. Now here's something else I'll show you. This is taking a little bit of a deviation from what I normally do, but I want to spend a couple of minutes on this in this video here today. This is the S&P E-mini 500 June contract, okay? This is the E-mini Futures contract. Now, anybody that's taken my course, I also give them, because there are a lot of traders that like to trade the S&P E-minis, I give them an opportunity to do two things. Number one is traders that take the course learn how to derive support and resistance levels, not only for the S&P E-mini Futures contract, but for any chart that they want to look at. Any stock, any commodity, Forex, it doesn't make any difference. All charts, again, act and react the same way, so you can find support and resistance using the strategies that are taught in the course. But here's the point I want to make, is that I give traders an opportunity to get my S&P E-mini Futures contract support and resistance levels each and every morning right before the market opens. Here were the levels from today. 28, I give a point spread. So what I did with the lines here is, like the level today was 2804 to 2805. So I split the difference, 2804.50. We traded up into that level slightly higher. And by the way, the high today was 2807 and a quarter. Also, here's a copy of the email that goes out to my subscribers. You can see it comes right before the opening bell, and I just give simple numbers. These are support and resistance numbers. And you can see right here, 2808 to 2809 was the next higher level of resistance that we were expecting. And these numbers down here are all the numbers you see on the chart. So let me get rid of that. And so the next number was 2808 to 2809, and the high today was 2807 and a quarter. Missed it by 3 ticks. That's okay. So the next one down, 2804 to 2805, you can see what happened. The market opened up, traded up to that level, went slightly above, came back down to retest the level of 27.99 to 2800, bounced off that. That was a little bit of a trade. Went down to the next level, little bounce. This level didn't work as great. They don't all work 100% of the time. But what happens is, and what I can tell you is that when you put the information in the course together with these support and resistance levels, we know when to take a trade, we know when not to take a trade, because it all depends on how the market is coming into the price level that determines the probabilities that the trade is going to be successful. And it has to do with how long did it take to get there, what's the market doing when it gets there, did it put in a signal of a trend change? All those things are extremely important, but you can see here, 27.73 to 27.74 was a level. And guess what? Look at the low at noon today, 12:10 in the afternoon. The low was 27.74. You can go back to the email I just showed you, rewind the video, and you can see that was the level. And then at the end of the day, where did we come right to? 27.65 to 27.66. Here's the low, 27.65.50. And you can see what happened. We dipped below it a little bit. First, we had a nice bounce off that level for a few points, right? That was 5-point bounce off that level. And then we dipped below it right at the end of the day, and we ripped higher in the last few minutes of the day, the last, 10 or 15 minutes of the day. You can see us rip right into the resistance point that was 27.73.74. So these levels are very good, but they're most useful when you put it together with all the other information in the course. Okay, enough with the commercial. We're back to the IWM. We'll take a look at the daily chart of the IWM, and we'll get back to our normal stuff. We talked about it yesterday. What did the IWM do? The IWM put in a doji candle. It's a signal of a trend change. It was in the right place at the right time in terms of how long the market took to get up to that point. And when it put in the doji from the last pivot low, that was important. That was certainly telling us that the market was unlikely to go any higher right now. The probabilities were telling us that either sideways to lower prices are coming. So we were able, if there's three possible scenarios, higher, sideways, or lower, we were certainly able to eliminate with a high degree of certainty higher. That was off the table. So it was lower or sideways, and frankly, the probabilities were lower based on the fact that we were short-term overbought. We talked about that yesterday. But keep in mind, there's nothing bearish here. There's nothing bearish on the chart. It's a down day, nothing more, nothing less. The IWM was down 0.4%. And when you take a look at that against the spider that was down 0.7%, the S&P 500, you say that the IWM had relative strength. So even though they were both down, the IWM was not leading the market in the downward direction. What does that tell you? That tells you that the likely scenario, unless things flip around and the IWM begins selling hard, the likely scenario is this is just a pullback working off some overbought condition in the markets, and the market can go higher after working off some of this overbought condition. If the IWM starts leading the market lower tomorrow, things will change. We could sell hard. But right now, today, as of the information we have after Tuesday's session, we know that the IWM had relative strength against the S&P 500, against the Nasdaq market, and against the Dow Jones Industrial Average. That bodes well because the money really wasn't running away from the risk assets in the IWM or the Russell 2000 index. Transports, second favorite market leading indicator. It was up today. So we have a divergence between the IWM and the transports, but the transports are up, and the divergence really isn't between the two favorite market leading indicators. The divergence is between the transports and the IWM and the rest of the market. So my favorite market leading indicators had relative strength against the rest of the market. So I'm not going to fall in love with the downside. We mentioned that before. Don't fall in love with the downside unless things change, unless we see the transports and the IWM begin leading the market lower. This is how you stay out of trouble. We did go higher today in the transports, but certainly sold off to close not on the lows of the day, but nearer the low of the day. And what's important is this level right here. We tested it today and it failed. If we close above that level, that's going to be a bullish sign for the transports. So if we just go sideways like this for a few days, 2, 3, 4, 5 days, something like that, then that's the market's way of telling us it's building energy to go higher yet again. So we have to watch the transports very closely. If they begin to just go sideways and certainly stay inside the low of 10,511 from the 9th of March, as long as they stay above that level and don't close any day below that level, then the transports can still be building energy for another push higher. So here are your lines in the sand, bullish, bearish. If we get above on a daily closing basis this level right here, that'll be bullish. And if we close below this level right here, that'll be bearish. In between, the market is really just building energy or consolidating to go higher. Before we move on to the next market, I want to make mention of something because I'm going to get this question. I get it all the time. When I showed you the chart of the S&P EMini Futures contract, and we'll go back to that for a second. That's March. We don't want March. Here's the June contract. So I'll go back to the intraday chart. And traders will say, well, I don't trade the EMini contract. I don't trade futures. How can I use this information to my advantage? Well, you don't have to trade EMini futures contracts. You don't have to trade futures at all. You just have to know where price is, and you can get the price of this futures contract anywhere during the day. It's available on any number of, free websites out there, your trading platform, anywhere you want to see it. So when price comes into one of these levels, I have plenty of traders that trade the spider, they trade the exchange traded products, the leveraged exchange traded products, options, whatever they want to trade is fine. When price coincides with one of these levels in the E-mini contract, you can buy or sell any of the other vehicles you want, and it's a good indication of what the overall market is doing anyway. The SPY will track pretty much penny for penny and tick for tick with the S&P E-mini futures contract, so they're all one and the same. They're just different vehicles. All right, we looked at the Qs last night, the Nasdaq market, so we'll look at it again, and we talked about the fact that we did make a new high, but we put in a pseudo doji candle yesterday, and that's generally a sign or a signal of a trend change. We had a nice reversal candle today, but keep in mind, this is still in an uptrend. There's nothing wrong with this market. Just because we had a down day, again, don't fall in love with the downside. We were just a little overextended from the 20-period moving average or home base. We were making new highs. There's nothing wrong with this market. We're at all-time highs, just a few cents off or a couple of bucks off all-time highs. There's nothing wrong with this market. It's certainly not bearish. If I look at a longer-term chart, here's a weekly chart. Look where we are. This is in an uptrend. It's very strong, and there's a long way to go in order to break that uptrend. We would have to sell very, very hard in order to break this uptrend. I'm not saying later on this year we won't. We may, but right now you don't have to worry about later on this year. What we have to worry about is right now. We have to worry about the here and the now. We don't have to worry about June or July or August or September. It's not important right now. What's important is the chart in front of us, and the chart in front of us is bullish. We're just going to come down to check back in at around the 20-period moving average, or let the 20-period moving average come up to price. There's a gap right here that'll most likely get filled right around, what's the number? The gap is 169.86, so it's a couple of dollars lower from where we are now. Don't be surprised if they fill that gap, but this is just a pullback in an overbought market that became overbought over the last week and a half. Nothing more, nothing less. If we get below the moving averages and the trend turns down, that's a different story, but that's not where we are today. The gold market. So there's, again, not a lot of change in gold. It was up about $6 today, but again, we're still below the 20 and the 50 moving average. We're sandwiched in the same range we talked about the last several days. So we're sandwiched in here, and there's not much to do. However, what I said yesterday and the day before is there's no defined pattern that we can identify that's telling us that the market has a high probability of going in one direction or another. However, we're beginning to form something. So we have a down move, and now we've been going sideways for 4 or 5 days. And the longer we go sideways underneath these moving averages in this fashion, the more likely the scenario is that we're going to have another down move. How does that come off the table? Meaning, how is the down move taken off the table? Well, the down move's taken off the table first by getting above, on a closing basis, the 50-period moving average. That's number one. But that's just the first indication that the down move is going to be off the table. The second one is getting above this level right here. If we close above that level, and that level is 1342 even. If we can close above 1342, then the bearish pattern is off the table and the trend will have turned back, at least the short-term trend will have turned back up, and it will be bullish behavior. But until and unless that happens, we're beginning to form a bearish pattern. So I would be careful. It's still not giving us a distinct reading one way or the other on which way it's going to go. However, we're beginning to form a bearish pattern. Crude oil struggled a little bit today, down almost 1%. It's not a big deal. I would say that, interestingly enough, the line in the sand is going to be the low from the other day. So the low from Friday was $60.14. So right here, $60.14. If we close below that low, then I think that we're going to come down and retest the $58 level in that neighborhood. The 100-period moving average won't be as strong as it was when we approached it at the first run over here. Okay, we never hit it, but it certainly would have provided support. But we came close, we rallied up pretty good, and now we're basically consolidating over the 100-period moving average. That diminishes the importance of the 100-period moving average in this case. So what I would say is our line in the sand right now, at least in the short term, is $60.14. Any daily close below $60.14, and I think $58 is in the cards to test around this double bottom. 58 and a quarter, 58, in that neighborhood, 58.50, something in that neighborhood. So we'll have to see. I'm paying close attention to it. If we go the other direction and we get above the 50-period moving average, then we can begin talking about the bullish stance and some higher numbers. Until and unless that happens, right now, crude oil is struggling for the time being. However, you see this trend line? If these lows hold, then that'll be bullish and we could take off to the upside, so I would not rule that out. I'm not necessarily looking for downside in crude oil. I'm looking for this area to hold, and I'm looking for a rally to ensue sooner than later. If it ensues tomorrow, fine, but it might take another couple of days as long as we don't close down here below that level. If we do, then I think we come down farther. But if this trend line holds, then I think we're in business for more upside in crude oil. So keep your eye on that trend line right here and whether or not that's going to hold. And that's pretty much everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.